Welcome to the second module in our trustee training series. In our last lecture, we talked about the responsibilities that trustees carry to ensure that their scheme is well managed. One of the measures of a well-managed scheme is the financial soundness of the scheme. And to talk to us today about this important topic is Irene Zambelas, who's a stalwart of the industry and an independent training provider. Welcome, Irene.
Thank you, Heidi, for this opportunity.
So in this lecture, we're going to provide an introduction to medical scheme financial soundness. And we'll cover the following topics. What is a medical scheme? The financial soundness, scheme income and expenditure, the regulatory oversight, capital requirement, the criteria for evaluating financial soundness, the health squared failure, and a look at Sizwe Hosmed's performance. So let's start, Irene, by looking at what a medical scheme is.
Thanks, Heidi. And put simply, a medical scheme is a financial product. It's a body corporate capable of suing and being sued, not for profit. It does assume liability for guaranteed benefits in return for a contribution. Every medical scheme must be registered with the Council for Medical Schemes and comply with the Medical Schemes Act. I have referenced on the slides the different sections of the Medical Schemes Act that are relevant. So you can see here, it is section 26 that talks about a medical scheme being a body corporate, and section 32, the binding force of the rules. It's important that trustees should try and start reading the Act if they're not familiar with it, and understanding the legal side of the scheme.
So is it fair to say that one of the key purposes of a medical scheme is to protect members from catastrophic expenditure?
Absolutely, Heidi. The important thing is that patients are responsible for all the bills and healthcare expenses they incur with providers in the private healthcare space. And we know that an ill event is an unexpected, often unexpected event, and you don't always know the cost implications of that. So costs can be incurred with private hospitals, specialists, laboratories, and it can come to hundreds of thousands of rands, if not sometimes I've seen in the millions of rands for an ill event. So what some members do, those that can afford it, buy medical scheme cover to protect themselves against these expenses. And the schemes then undertake for certain benefits at a certain tariff to pay the providers. And this means that the schemes now take on that risk of those unexpected, often health expenses that they must then fund and make sure that they've got sufficient resources for those expenses. Because remember on the previous slide, we said guaranteed benefits.
So where does the income for a scheme come from?
This main income of the scheme comes from the monthly contribution. And it's important that trustees understand the importance that they have a good credit control policy, that only the members that have paid their contributions get benefits. But added to this income is the investment income schemes receive from investing their reserves. And that goes into the scheme's bank account. And that is important. The other important part is that the contributions get pooled. So we all put our contributions into a pot. And just to give you an indication of the size of the industry, contributions received in 2024 for just over 9 million beneficiaries, Heidi, came to 227 billion rand. That's a significant pot of money. The important question for trustees is, how well is this money spent? And when we look at this money, the money from the pot then gets used to pay for the healthcare services. And the amount that was paid of the 227 billion to healthcare was 218 billion rand. So the point here is that the bulk of the contributions goes to meeting the healthcare expenses. But we cannot say that that's all the scheme's expenses. Schemes also have non-healthcare expenses to pay out of the same pot. So the trustees must make sure that they have sufficient money in the pot to meet these expenses.
So why is it important that trustees need to understand about healthcare costs?
I think, Heidi, if you think of the major responsibility of trustees is to make sure that the scheme is financially sound and a going concern. And if the bulk of the expenditure is healthcare, over 90% of contributions went to healthcare expenses, then understanding those healthcare drivers also allows trustees to understand how they can try and manage the risk. And that's a topic for a different discussion. But what trustees need to understand as basics, the healthcare expenses are made up of the number of claims multiplied by the cost of each of those claims, multiplied by the quality of care. If you bring all three together, that brings together the total healthcare cost for the scheme. There's just one thing I need to add, Heidi, for trustees. They need to read the reports that they receive on the utilization of benefits. That will itemize the number of claims and the cost of claims, and will include information on quality of care so they can understand their healthcare cost drivers. And the scheme rules that what benefits are included to meet the healthcare needs of their beneficiaries.
I'm glad you mentioned the quality of healthcare. Can you talk a little bit about why it's relevant?
The reason why it is relevant, Heidi, because if trustees can try and prioritize in their benefits appropriate screening, benefits for appropriate screening, benefits for preventative care like immunization, and also treatment that is provided by healthcare professionals with the best health outcomes. And we know the focus is a lot on value-based healthcare as being cost-effective.
Schemes operate in a very highly regulated environment, And this obviously increases their risk. In 2000, the Medical Schemes Act introduced social solidarity principles like open enrollment and prescribed minimum benefits and community rating. How does this impact the scheme risk?
You're right, Heidi. And what we have seen, that schemes have experienced very high utilization rates of their benefits. And I'm using that term on purpose so that trustees understand utilization and how it impacts the number of claims coming in and the cost of claims. And what happens with with open enrollment and community rating PMBs, it has opened schemes up to the risk of anti-selective behavior, where members join the scheme because they have a need to claim. And what trustees need to do is understand for their risk pool, how at risk are they of anti-selection? Because then that places them in a better position to put risk mitigation tools in place. But in addition to these legislative requirements, the risk pool is also impacted by size. What is the size of the risk pool? The number of beneficiaries. Because a bigger risk pool has a better spread of risk, they've got better bargaining power, they can predict future health claims better. So there are advantages to being bigger. It doesn't mean that smaller schemes are at risk. It just means that bigger schemes have a better advantage. In addition, the average age of a scheme and pensioner ratio impacts the risk of that risk pool. So schemes and trustees need to understand if you've got a higher average age, you must expect higher claims compared to a younger scheme. And then the burden of disease of your scheme is important, that you have that understanding, because that does impact your utilization. And it determines if your risk pools are high, medium, or low risk pool. And the impact of benefit design is important for trustees to understand what limits and co-payments and deductibles they need to put in place and manage care.
But Irene, irrespective of the richness of the benefits that the scheme offers, schemes like any other business must be financially sound. And this means that the income must exceed the expenses. Can you talk a little bit about this?
Absolutely, Heidi, because we know that schemes are not for profit, but that doesn't mean that they don't have to be a going concern. So the assets must always increase the liabilities. So it's incumbent on boards of trustees to be able to have a steady income, manage expenses, in other words, making sound financial decisions as a board, managing the resources effectively, and not only addressing today's needs, but making provision for tomorrow and having enough savings in place for the unexpected expenses. We know that healthcare is often unexpected, and it's difficult to predict your future healthcare expenses to its 100%. So that's why schemes need to have savings in place as well. So I just want to, Heidi, focus a little bit so that we're all on the same page when we understand what assets and liabilities are. And an asset, as Investopedia tells us, is something the scheme owns. So the contributions and the accumulated funds of the scheme are assets. A liability is what the scheme owes. So that is the healthcare expenses and the non-healthcare expenses.
I know terminology can be very confusing for a non-financial person. So it's good that we're pausing for a moment to look at what these financial terms mean.
So when we look at it, as Heidi, as you say, they can be a bit confusing, but scheme financials can be quite simple in a way if we look at income and expenses, like our household budget. Just the schemes take it a bit to the next level. So when we look at scheme assets, we're talking about the contributions, and the way the financial statements will reference the contributions is talk about insurance revenue. And this is using the latest accounting standards, which is IFRS 17, and insurance revenue in this context, and this is an important point, excludes the savings portion of the contribution. The word insurance revenue mustn't confuse people that this is an insurance product in terms of insurance laws. Medical schemes are medical scheme products, but the word insurance is the terminology used. We mustn't forget that with assets, the accumulated funds, the savings portion, the funds that are left in the scheme once all expenses are paid, is what we call accumulated funds. They are the reserves. And it's these funds that schemes use to calculate their solvency, which we'll come to later. If we then look at liabilities for a scheme, like we mentioned before, the liabilities are healthcare expenses, they're the non-healthcare expenses. But trustees must also understand that the portion of the medical savings contributions paid by members is also a scheme liability, because the scheme will have to pay that amount to members should they leave the scheme. Because schemes are not for profit, we never talk about a scheme making a profit or a loss. We talk about if there's money left after expenses are paid. We talk about a surplus, which is what the preferred situation for a scheme is. If, however, the schemes have spent more than what they have, then that's a deficit. Schemes, however, must always be financially sound.
I'm glad we've included this slide because I wanted to understand a little bit about what the Medical Schemes Act says about the financial soundness of a scheme.
And I think, Heidi, you're right in that what the Act says, that it's uncompromising at all times. Schemes must maintain themselves in a financially sound condition, having assets, sufficient assets and more assets than their liabilities. So you can never be in the red as a scheme.
You mentioned earlier that over 90% of the scheme's expenses are healthcare related. Can you break this down for us?
And I think this is important, Heidi, because it also talks to benefit design. So the starting block for benefits for schemes is the prescribed minimum benefits. We know that schemes must pay for them in full, and every option must have sufficient benefits for PMBs. or must provide for all the PMBs. The average cost of these PMBs in 2023 is of interest. As the starting block, per beneficiary per month came to 1,145 Rand. I believe that has now increased to 1,500 Rand. So it's a significant starting block if we're thinking of affordability for schemes. Now the trustees need to make a decision. How much more are they going to add to benefits over and above PMBs? And this is your non-PMB basket. And the average cost in 2023 for the non-PMBs came to 1,000 Rand, which actually brings the total cost per beneficiary to 2,200 Rand. Just to note, these are 2023 figures, and they have increased significantly. And it relates to the affordability for medical schemes and how relevant it is for trustees to focus on their benefit design.
Wow, that's a mind-blowing figure. So this graph, Irene, shows the PMB expenditure per beneficiary per month. What is the relevance of this?
I love the slide, Heidi, because I love it and probably hate it at the same time, because it does put the scheme at risk. But what it does show, how aging increases the risk for schemes. So let's take it bit by bit. The left axis shows PMB expenditure per beneficiary, and this axis here, the horizontal one, shows you the differences by age group. On the right axis is the number of beneficiaries per age group. So where I'd like to start is that this black line here shows the average cost of PMBs per beneficiary, which we have already mentioned. But just to put PMBs into context, there are 297 conditions that are included in the PMB basket. What is interesting to note is that by age group, can you see the less than one here, Heidi, has come above the average? Then the cost dips significantly, and that's the orange line that we are following as cost per age group for PMBs. And can we see that the younger people cost is really very low, and as we age, it increases exponentially. And the relevance here is that schemes need to have more younger, healthier people to cross-subsidize the higher utilization of older people. And we don't have a mandatory membership in South Africa. I know the medical schemes have been lobbying government to introduce mandatory cover, that everyone employed earning above a certain income threshold must belong to a scheme to try and increase the younger, healthier. And we know that isn't in place. So it's something for trustees to understand, that they need to work harder at managing this health risk that gets posed.
I think we have something like 71 medical schemes in South Africa and about 250 options across those 71 medical schemes. And each option has its own benefit package and contribution. Can you talk a little bit about this, Irene?
It's an important one, Heidi, and I think the lesson here is that trustees focus on how rich their benefits are going to be. And I mean, that is a difficult question because everyone wants to add as many benefits as possible to provide members with more. The way that the council categorized the different options according to richness of benefits was in 3 categories. And we can see here that they started off with the comprehensive plans. And these are the plans with the richest benefits. So it's PMB plus quite a bit more. And we can see between the open and the restricted schemes that the half of the restricted schemes are comprehensive in their benefit design. The important thing here is that these beneficiaries will have less out-of-pocket expenses. We can see that 22% of the open schemes were comprehensive. So if we then go down a notch in benefits, the partial cover plans sit in between the hospital plans and comprehensive and richness of benefits. Once again, we can see that 45% of the restricted schemes are partial cover plans and 23% of open schemes are. And then the leanest of the benefits that are closest to PMBs is your hospital plans. And we can see here a turn that 43% of your open schemes are hospital plans, which means that the out-of-pocket expenditure increases. And if we think of the size of out-of-pocket expenditure that the council has estimated at 40 billion rand, it's quite a significant portion and something trustees must take into account when they plan their benefits.
Irene, age is so important. It's such an important contributor to the cost of care. The average age by scheme type in this graph shows how medical schemes are aging, which obviously translates into higher healthcare expenditure. And I think of particular interest is the difference in average age between the open and restricted schemes.
And I think, Heidi, you're right. I mean, there's in 2023, the average age of open schemes was 4.5 years more than your restricted schemes. And we can see that trend happening over the last 10 years. And it's because of anti-selective behavior. And for restricted schemes, where it's a condition of employment to belong to the scheme, they are at lower risk of anti-selective behavior because people join the scheme because they have a need for employment, not because they have a need to claim. And that is important.
Mm-hmm. Irene, it's important that trustees are familiar with the terminology used in the financial statements of the scheme. Can you talk a little bit about the trustee's responsibility and why it's so important for them to understand this?
I think, Heidi, when we look at what is included in the financials, like I mentioned earlier, the scheme financials are not complicated, really. The devil always sits in the detail. So importantly, that trustees understand what are the drivers of their claims. You understand your healthcare risk, but included in that, and this is also for terminology, schemes must make provision for IBNR And IBNR is incurred but not received claims. And this estimation, gets made from previous claims history. Go back 5-6 years, and to try and predict what may be coming in. And also using claims that you can expect that have been authorized through pre-auth. That can give you an idea of what may be coming through as an expense. So those are your healthcare expenses that you need to make provision for. Then you need to look at your non-healthcare expenses. And these are included in your financials as directly attributable insurance service expenditure. And we can see here it's simply the administration costs, running the accredited administration, other administration, broker commissions, and other expenses. So here we can see it's more the day-to-day running of the scheme. Here the other DAE will be included, like legal costs, auditing fees, marketing fees, that also get added to make up the non-healthcare expenditure. I think the important thing here is the detail must be correct. Everything must be itemized. Every cent that was received by the scheme and how that money was spent. So it's that detail that's important. There's another category of expenses that must be added, and that is the managed care expenses. And here trustees need to make sure, because they're using members' money to buy managed care services, that it's about managing your health risk, and you need to measure the return on your investment. There are 2 types of managed care service agreements, and remember this includes disease management, case management, formularies, protocols, all of that. And those are agreements with and without risk transfer. So when they've got risk transfer in them, which is the preferred way of doing managed care, is that the scheme puts the risk to the providers and shifts that risk from the scheme, which is why we say it is preferred. It's not always feasible, but it is the preferred, as opposed to having no risk transfer in place.
And I think that you're so right that trustees need to be able to account for every cent that the scheme has received and how that money was spent.
It is, especially in this environment. It's actually a risky environment we're working in.
So, Irene, over the past few years, medical schemes have generally experienced greater healthcare expenses than they budgeted for. You have these figures from the CMS annual report. Can you take us through them?
Heidi, they don't paint a pretty picture, so I hope we're not going to scare trustees away from this. What you can see is we've got deficits here. So in 2022, the schemes as a whole, the 71 schemes, had a deficit of 2 billion. That deficit increased to 6.7 billion in 2023. We can see these are the deficits divided between open schemes and restricted schemes. So we can see the open schemes suffered a bigger deficit. This means that insufficient contribution income was collected. But there is a ray of sunshine here, and that is in the form of investment income. And the investment income from investing the reserves, those accumulated funds, changed the position. And can you see here, Heidi, that deficit for open schemes going from 3.9 billion went to not quite a billion deficit, but that the restricted schemes had a 2.2 billion rand surplus. So that schemes as a whole had a surplus at the end of 2023 of 1.3 billion rand. So we know that insufficient contributions were collected, but thank goodness for investment income. Of interest for schemes and trustees to know is that the Act is clear that schemes may only put in as an expense, and this is according to Section 26, relevant health services as the scheme rules provide for. Remember, they guaranteed benefits if they're in the scheme rules, plus the cost of investing money. So the management of the investments carries a cost, plus the costs for carrying on the business of a scheme, which is your directly attributable insurance service expenditure. And all of that needs to be meticulously documented to be able to say, this is what we've collected and this is what we've spent. And that is so important. The Schedule 30 of the Act says that schemes may provide for ex gratia payments, where they pay under certain conditions for more benefits than what is allowed in the rules, in the scheme rules. But that needs to be also managed correctly.
Irene, we've spoken about many things that impact scheme financials. And these are the PMBs, the age of the beneficiaries, etc., etc. And we know because of those factors that there are many options that are not self-supporting. Can you take us through a little bit about what the Act says about this when an option is not self-supporting and how it is that these options are allowed to continue?
I don't know if I can answer the second part of that question, but what we can say is that the Act, you can see here, Section 33 of the Act, does say that each option must make provision for PMBs, and they must be financially sound and not compromise another option of the scheme. And I think just for clarity, we have some schemes that have only one option, and then other schemes that have over 20 options. I think the important thing for trustees to understand is that each option is a risk pool on its own. And the more options you've got, the smaller your risk pool. So obviously, if you're a small scheme, you can't have many options. The council, we know, has not enforced this up to now, but we don't know how the council's going to respond going forward. So one needs to be aware of what your position is with your options and what plans you can make should this be enforced.
I think, Irene, it's important that trustees are familiar with the Medical Schemes Act, but in the slide you draw attention to the relevant sections that should be familiar, that trustees should be familiar with, that when a scheme may not be financially sound.
And I think that, Heidi, I mean, you read about it in the papers, unfortunately, or you get circulars from the Council for Medical Schemes telling you about schemes that are in financial trouble. So what the Act actually says is that if schemes are unable to be financially sound, that they have an obligation to inform the council, and that the council wants to know what are the reasons and what are you doing to correct it. What is your business plan? And failure to do so means you're guilty of an offense. I think the important thing is here that one is responsible for spending other people's money, and that you do it in a ethical way and showing that you've always acted in the best interests of members.
Mm-hmm. So who has the responsibility to ensure financial soundness of a scheme? The million-dollar question.
You know, Heidi, the real responsibility first sits with that board, the board of trustees. But council has an oversight function, and their job is to protect the interests of beneficiaries at all times. But like I said, the board of trustees has the ultimate responsibility, and they have to be fit and proper. And I must add the principal officer in here, the PO, who's the CEO of the scheme. And fit and proper is important because fit means that as a board, a collective, there's the skills and knowledge required to manage the scheme. But proper means that you're always acting in the best interests of members with due care and diligence. So when people say to me, oh, but I was appointed because I'm popular with the membership, you've got to understand, if you've accepted the position, it means that you have something of value to add to the board, and with it comes responsibility and accountability. The important thing here is that the Act goes further and says that an auditor must be appointed. And we've seen reports about auditors. Importantly, that trustees apply their mind as to their selection of auditor, the cost of the auditor, the experience of the auditor with medical schemes, understanding the auditor must be independent, because they're going to verify that the financial statements accurately reflect the financial position of the scheme. And the council has to approve the selection of auditor. And I need to just say, you want an impartial auditor also, an auditor that isn't affiliated with the administrator, so you avoid conflicts of interest. In addition, and I can't stress this enough, is the relevance of an audit subcommittee that the trustees have. You know, trustees generally can appoint however many subcommittees they need to help them manage the scheme. So this audit subcommittee is the only one that is mandated by law. And it tells you in section 36 how many people must sit on the audit committee, but the importance of this audit committee to advise the board. Remember, decisions get made at board level, cannot be overstated. It is so important to have a good audit committee in place.
So that brings us to the calculation of the capital required, and it's a fine balance, balancing affordability with the need for benefits. Tell us how a board would go about this.
Absolutely, Heidi. And I think just to bring us back to the point, Heidi, that healthcare expenses predicting healthcare expenses is not 100% science. So the best of actuaries may still get a certain percentage wrong, if I can put it from actual. But what the need for contributions, the final decision gets made by the board. But the board may employ skills that they lack to help them predict their future expenses. And that is the role of the actuary. An important thing, if trustees want to read up on what kinds of things do the actuaries take into account when they make this determination, is a notice that your Actuarial Society of South Africa published, APN 303, that hopefully you'll be able to make available for your trustees.
Yes.
Heidi.
We will.
Together with a copy of the Act, which will give it to them to be able to reference. And it's interesting to see how the actuaries come to that figure. It's a very important one because you saw earlier the deficit that schemes were experiencing. And that deficit is because they underpriced their product. And so getting a good estimate from your actuary is so important.
Mm-hmm.
In addition, Heidi, I mentioned investment income. Now, schemes sit with quite a bit of money, like 140 billion, which we'll come to in their reserves. It's a lot of money, and that money needs to be invested wisely. So most schemes have an investment subcommittee to advise the Board of Trustees on their investment policies. Schemes are restricted in which asset classes they may invest in. Our asset classes choice are keep money in cash, invest in bonds, invest in property, equities. Those are the kinds of asset classes. But Annexure B to the regulations of the Act sets out the maximum percentage of reserves that schemes may invest in. And remember, if you invest in certain asset classes, you get a higher interest return on that investment, which can increase your investment income. An important thing on those investments is that whoever you put on your subcommittee, that they are very familiar with the investment market and how Annexure B works.
I'm glad you mentioned Annexure B and the reserve requirements, because a scheme must maintain a level of savings as a buffer should their expenses exceed their budget. Is a scheme always financially sound if they've met the regulatory requirement of 25% of their gross annual contributions?
Wouldn't that be wonderful if it was the case, hey, Heidi?
Absolutely.
Because it would make schemes more affordable if they could have less in their reserves. The law says, and this is section 29 of the regulations, says that the minimum requirement is 25%. What we can see from the Council's annual report is that the average for open schemes is 34%. So we can see it's still higher than your 25% minimum requirement. We can see that for restricted schemes, the average solvency was 57%, even more than open schemes, significantly more. And that is because 25% is a minimum requirement, and it doesn't mean it meets the needs for that individual scheme's risk pool. Each risk pool must be assessed based on their risk for the solvency requirement. Remember, it's to protect a scheme against going insolvent. Solvency means you're solvent, you're a going concern. If you're insolvent, you've run out of money. And that's not where you want to be. So the risk-based capital approach is the prudent approach to follow. And you cannot assume that 25% is sufficient. For a few of our schemes, 25% may be too much for them, but they still need to meet it because it's the legislative requirement. But for a lot of our schemes, it is not sufficient.
Thanks, Irene. So can you talk a little bit about the asset classes that you've showed in this pie chart?
And I think, Heidi, the important thing here is to see, and we saw that restricted schemes in the previous slide had a higher solvency than our open schemes. And you can see that because as a group in 2023, there was 140 billion rand that was sitting in reserves for all schemes, divided between 74 billion for restricted and 66 billion for open schemes. And we saw that in the solvency. In this slide, it shows that out of that 140 billion, 42% was invested in government bonds. Then 26% in equities and 25% in cash and a small amount in property. An important thing to understand here is schemes need to have enough money available in cash, giving them liquidity, because they have to pay their monthly claims expenditure, the payment runs, and their non-healthcare expenses. And they must have enough cash for that. Bonds gives them liquidity, it gives them that cash, and it gives them a slightly higher rate of return than cash. Obviously, cash gives you liquidity. Equities is investing in the stock market, and it allows you a longer term investment, but to get a higher return in the long term. Annexure B, and I must also point trustees to Circular 3 of 2025 from Council, which is an update on Annexure B in categorizing the asset classes that schemes may invest in. And that happens every year. that there are updates to Annexure B, and that schemes understand that they cannot invest more than what Annexure B allows. They will be asked to disinvest because it is law. So whichever investment company they procure to advise them, they must be fully knowledgeable about Annexure B to be able to advise schemes. The other important thing for trustees is to have a very important, a very good understanding of what their need for cash is, so that they're never caught with insufficient cash to meet the payment run and their non-healthcare expenses. Are we good with that?
That's such an important point. I'm so glad you mentioned that. But of course, reporting on the financial soundness is also really important for trustees. Can you take us through a little bit about how the importance of that and how trustees should be reporting on the soundness of their scheme?
I think, Heidi, we know that accounting standards are being updated all the time to try and focus on transparency and accuracy. And medical schemes need to keep themselves updated with the accounting standards. IFRS 17, a case in point, that has been a recent upgrade. The Act says that schemes must be able to have income statements, cash flows, balance sheets, auditor report. And there's an audited financials happen for each of the financial years of the scheme. However, schemes must also submit financials on a quarterly basis to council, detailing what money's come in and where the money's gone to, and also to note that council has the right to ask for additional reports or to conduct inspections of schemes. Remember, they're the oversight regulator, the policeman of the medical scheme industry. And just to let trustees know that the financial year of the scheme is a calendar year. And we know come the end of the year, we all used to bemoan the fact that our benefit changes are happening on the 1st of January, and we had to be available for any glitches in the system with the changes. Which is something that we need to be aware of. But I want to highlight something here, Heidi, and having said that the scheme's financials are simple financial statements, they're nothing complicated. The devil, though, always sits in the detail. And trustees need to be a bit like CSI in this. And evaluating schemes' financials, it's an objective exercise. It's not a marketing exercise. One needs to look at a number of things. The first thing that I've got here is, what does the actual scheme stats say? So what is my solvency? What is my membership? What is my average age? What is my pensioner ratio? Those are individual stats for now. Then you want to look at what are the trends of your scheme, your risk pool. Are you heading in the right direction of where you want to go? You then want to look, how do you compare with the industry benchmark? So if the industry benchmark is an average age of 35, how am I comparing to that average age? And how has the scheme performed? Actual versus budget. Remember, you've prepared the budget for your scheme going forward. And how has that performed for each of the months of the scheme? And to be able to interrogate if something doesn't look okay, ask the question why. And never look at one statistic in isolation. Let me give you an example. I can see that my solvency has increased. Isn't that a good thing? Going, yippee. But then I go to the next stat and I can see my membership has decreased. And that's why my solvency's increased. So must I now be happy with the solvency increasing? Not really. Because why is my membership going down? And that may not be a good thing. So we've got to look at a number of factors as a whole and then determine the financial health of the scheme. And it does take some practice. So I've listed here some of the important criteria, Heidi, and to look at. It's not an exhaustive list, I must add. The first thing to look at, your scheme size. And I've mentioned the benefits of being a big scheme in size. The other thing, which for me is the financial pulse of the scheme, is the contribution versus benefit ratio. What percentage of contributions was spent on healthcare expenses? It's such an important measurement of financial soundness, because it will instantly tell you, have you brought in sufficient contributions or not? Was that calculation correct? And we're going to come to the next slide to give us some of those stats for the industry. The next one is age and pensioner ratio. And I think pensioner ratio, we know, is the percentage of your beneficiaries that are 65 years of age or older. And we've discussed age and the impact of aging on a scheme. And just to add to that, for every year your scheme ages, actuaries on average will tell you, add 3% to your contribution increase.
Oh.
All the other things being equal. Obviously, it's not as simple. We're not advising that for schemes in any way, because they're going to get the actuarial evaluation. But that's how important age is and the impact of aging on utilization of benefits. Burden of disease we've mentioned. The one thing I haven't mentioned, AD, is a global credit rating. And this is optional. So a lot of schemes get it as a marketing exercise, but the value a global credit rating can provide is to give schemes an independent assessment of their claims paying ability. And you get rated AAA, AA, A, B, whatever, to give an estimate. And the emphasis here is on independent assessment. But there's a cost to having it done. To look at your operational result. Once you've paid your expenses, are you in a surplus or are you in a deficit? And how does that compare to your budget? Then to look at your non-healthcare expenses. Have you purchased them acting always in the best interests of your members? Because remember, you're spending member money. And then solvency. But we can add, do you have managed care, risk transfer arrangements in place, a whole lot of other things to the pool, also referencing the APN 303 document from the Actuarial Society. So, you know, Heidi, this is quite a disturbing slide.
Yes, it is.
Because it does show those contribution versus benefit ratio. And now it's been called relevant healthcare expenditure. So I need to just point out that we always used to say an ideal ratio is 85% of contributions to be spent on healthcare. And the reason why we would say that is because you've got to add non-healthcare expenses as well. Can we see from 2017 to 2019, that contribution versus benefit ratio has been increasing? We then got the COVID honeymoon. It seems a bit bad to put it in those terms, but we know the healthcare expenditure for schemes decreased significantly over COVID because the planned procedures weren't done. But then look at that bounce back and look how that ratio for 2023 is nearly 96%. And if you add your non-healthcare expenditure to that, you've spent about 103%. That 3% over expenditure must come from your reserves. That's why we saw the reserves come down year on year. From 2022 to 2023, there was about a 3% decrease in reserves for both open and closed schemes. And that's the reason why. So there was an underpricing of medical schemes that happened. And one needs to understand that as trustees. And my last slide on this, Heidi, and then we can go into both Health Squared and CSWE HOSMED, is looking at liquidity and how many months of cover schemes may have in cash. Can you see that in 2022 it was 3.5 months, 3.5, and that also went down to 3.4 months. So schemes are working in quite a challenging environment, if we think of it, and how boards of trustees need to really apply their minds.
Yes, and it's because of exactly the factors that we've been talking about now, that we've seen some scheme failures, some financial soundness failures in the industry. And I'd like us just to talk a little bit about one or two of those.
The shocker of the industry, I think, was Health Squared, Heidi. And I think Health Squared sits very clearly, certainly in my mind, and I'm sure in all of our minds, because we were inundated with stories, heart-sore stories of members that were having to shoulder personally the healthcare expenses because the scheme failed. And providers still want to be paid. They're not going to say, I'm sorry, your scheme failed. You don't have to pay the hospital bill or the drug bill or whatever. So we can see that Health Squared was formed in 2018 and it failed 4 years later. And that is something that should never have happened. Many people have said this merger should never have happened of Resolution and SpectrumEd, because the demographics were just not right. In hindsight, we've all got 20/20 vision. When we then look at, unfortunately, the trends, and looking at trends, can we see how the membership of Health Squared decreased significantly and quite dramatically in a short space of time, going from 37,000 to 23,700. That's quite a loss of membership. And that tells a story. You've always got to ask, why is this happening? Interesting to look at the age of Health Squared and pensioner ratio. And remember, we said compare yourself to the benchmark. So the average age of Health Squared, we can see, was quite old as a scheme, 47 years of age, average age for the scheme. The average age for the industry was 35.5. So that's a big difference, 12 years. And what it means in utilization for the scheme, increase in utilization. We can also see the pensioner ratio was sitting at nearly 26%, but the industry average for pensioner ratio was 11%, which means this scheme, Health Squared, was experiencing higher claims. Their solvency was the scary part of it all. Because once you see the solvency in 2019 was sitting well below the industry average. It had a very slight recovery a year later. And look at this dramatic drop from 17% to 6% to 2%, and then virtually to 0. And this is where claims could not be paid. And members were being presented with the bills to find on their own. So when we say schemes are there to take on the healthcare expenses and must have sufficient funds, we can see its relevance in this. And I like the wording of this report where it said that the actuarial report found that comparatively, Health Squared were highly overpriced when you compared them with similar medical schemes. However, they were underpriced when you looked at their profile, their age, their pensioner ratios, their burden of disease, and utilization rates of its members. So the message to trustees is, look at your risk pool. And that's where that capital, risk-based capital approach is so important. And don't underprice your product on the mistaken belief that you will gain more members.
I think this slide Yeah, thanks, Irene. Thanks for putting this slide up, because I think it perfectly sums up the complexities that face somebody or a board of trustees running a scheme. And I mean, this particular example was heartbreaking for the members of that scheme.
It was, Heidi, because it was in the papers, the individual financial hardship that these members suffered and are probably still suffering, trying to pay that debt. You know, if you haven't accounted for it because you think you've paid your contribution.
Yes, yes, absolutely. Let's look at a more recent example, which is not at the end of its journey yet, but let's have a look at it anyway.
Yeah, and I think, Heidi, there's many lessons here as well, and I'll go through it a bit quickly because we've been through some of the lessons that need to be learned. But looking at those trends, the Seasware Hosmed merger took place at the end of 21. So we're going back a few years. But one thing we can see here, that they started at quite a healthy solvency of 49%, 67,000 members, a reasonable membership size, and 1.4 billion in reserves. So when we look at this, we say, this is a healthy scheme. When we look at it 1 year later, that solvency halved. Now, this tells you a very different picture. And obviously, one needs to delve in a lot deeper as to what has caused this. And we can see within a few months, the solvency fell below the legislative requirement, which means more claims were being paid using reserves. The contributions were wholly inadequate for its expenses. And the council asked the scheme to submit business plans. And this in itself tells its story. 4 business plans were submitted because the initial business plans submitted were inadequate. And that in itself tells its story. And now we can see from 67,000 members, can we see how the membership loss has started? And council then stepped in and placed the scheme in August under statutory management. And this is statutory management's important for us to understand, that a statutory manager has been appointed by council to advise the board of trustees and assist the board, in managing the scheme back to financial health. And it was Joe Selowani, he's quite well known in the industry, with curatorships, etc., that took over. But the important thing here with statutory management is that the board of trustees is left in place. And the statutory manager is there to help manage the scheme back to financial health. But what we saw was the deterioration of the solvency of the scheme. And it's quite scary when you see scheme solvencies go to 6%. I don't know about you, Heidi, but that does not make for a good night's sleep.
No, absolutely not.
And the hardship that the scheme was facing. And can you see here severe financial and operational distress, solvency issues, regulatory non-compliance, member losses, unsustainable claims. So going from statutory member management the scheme went to curatorship, which means the Board of Trustees is now no longer in place. And a curator has been appointed, and the curator is Lebogang Mpakati, that has been appointed by council to try and manage the scheme and bring it to financial health. And there's options here. We don't know how it's going to work out. If it's going to be a merger, very hard to be a merger in this case, where reserves have been depleted. If it's going to be liquidation, or the scheme will continue, will be able to be revived and resuscitated. So there are various options, and one needs to just watch and see how it will recover. And we'll watch that with interest. Just as a note here, look at these claims ratios. Went from 95% to 99. 99 is close to 100 for my.
Yeah.
And if these are claims ratios, this doesn't include non-healthcare expenditure, by the way, which is why the reserves have gone down so dramatically. And obviously, these are 2022 stats. We know that would have deteriorated. So that is the sad story, and let's hope there is light at the end of Sizwe Hosmed's journey.
Yep.
So, Heidi, just to look at, and for trustees, for us to, I think this is the second last slide.
Yes, it is.
And what I wanted to just highlight in the slide is, if you look, I was looking at 2026 contributions for some of the open schemes. And if we look at BestMed, going from 2,200 principal member contribution to 7,000 contribution. And obviously, there's a big difference in benefits between all these different options. And we can see, I just chose 5 for Momentum, but look at Momentum's options going from 2,000 to 16,500 per principal member. And if you think of a household budget,
yes,
where you've got more than one dependent, it can be quite scary. And having to, beneath us here, we can see going from 3,600 to 12,500. So it's just highlighting the choices, the benefit design that one can offer, and the importance that we communicate these choices well and price everything. So my last slide is for trustees. Gain an understanding of the Act and its regulations. It is so, so important. Read it bit by bit if you are new to the industry. And know your scheme rules. You'll be surprised of when I interact with trustees and how so few trustees really know and have worked with their scheme rules. It's important to have a good understanding. And interrogate your board packs. Ask questions even before the meeting. Pose any queries to the principal officer, and always act in the best interests of members, making sure you add value and you can always act in the best interest of members and get good return on investment, be it administration contracts, managed care contracts, investment contracts, whatever the case may be. And we can all move to value-based healthcare, which would be the best.
Irene, thank you so much. I know you've included this slide, and it's such a good message to leave our trustees with. But I also want to say that it's an enormous responsibility being a trustee, and you have to be brave to be a trustee. But I think that this lecture has given trustees such a lot of important information, and pointed them in the right direction as to what they really need to be looking at in their Board of Trustees meetings and their board packs and the scheme financials. So thank you so much, Irene. It's really been a very valuable, and I know that you've also included a slide here on abbreviations. And I think our industry is full of abbreviations. So I'm very grateful that you've included this slide. Thank you so much.
Thank you, Heidi, and I hope we haven't scared trustees away. But also just to add that this is an introduction to financial soundness.
Yes, I think that's an important point. And Irene, if I'm not mistaken, our next lecture is going to be on PMBs, another vitally important topic for trustees to know about. And we will try and have that lecture up on the website before the end of 2025. So thank you so much, Irene, for this and for all the work that you put into this lecture. It was really, really valuable. And to anybody watching, I hope this has given you some insight. If you have any questions, contact Irene or myself. There was a slide, I think the one before this one, thanks Irene, that has our contact details on it. Thank you so much.